Welcome to Sifter Fund's quarterly review. In this presentation, we will cover Sifter Fund's performance in September and in the third quarter. And secondly, I will present the fund's top contributors and detractors during the third quarter. The fund's share price declined by 1.5% in September, but was positive by 2.6% in third quarter. From year to date, Sifter Fund has returned 21.4% and outperformed the global equity index by 3.1%. The rise of Japanese stock market towards the end of the quarter brought an additional boost to the fund's returns. The fund has 5 companies in the Japanese market with a total exposure of 13%. Correspondingly, the euro-dollar exchange rate was positive for euro-dominated investor, as the dollar strengthened by about 2.5% during the last quarter. In this quarter, Sifter Fund made one new investment. After more than 2 months of research, we concluded that Sony Corporation meets Sifter's quality company criteria. We believe that Sony's business areas are in good shape. In addition to that, we think that we were able to purchase Sony's future cash flows at a reasonable price. The Sony purchase was financed by selling off Oracle Corporation, which has been in our portfolio for almost 10 years and returned 250% in euros plus dividends for Sifter investors. Based on our research, Oracle is still high-quality business, but its growth prospects are fairly modest. Sifter Fund's investment principles have remained the same already for 18 years. The fund is a long-term investor in a small number of quality companies globally. What we care about is the quality of the business model and their money-making power in the future. We think that the very strongest businesses will do well in all market conditions, and therefore we want to own them for a long time. Let's take a look at some of our investments, their stock prices and business performance over the past quarter. The fund's biggest gainers during the third quarter were Novo Nordisk, Costco and Oracle. Correspondingly, the portfolio detractors during the quarter were Lam Research, Autoliv and VeriSign. I will start off by introducing to you a Japanese SMC Corporation, which share price rose more than 9% during the third quarter. SMC Corporation is probably an unknown company to most. The company is one of the world's largest manufacturers of pneumatic products, and the company was founded in Tokyo in 1959. SMC has a strong market share in its fields of about 37% globally and 65% in Japan. And Sifter invested in SMC 2015. SMC's typical customer segments include the semiconductor industry and the automotive, food and pharmaceutical industries. SMC offers products for pneumatic control technology for production automation. One of the SMC's competitive advantages is the size of its product portfolio and fast delivery times. The product portfolio includes more than 12,000 basic products and more than 700,000 variants, which cover almost all aspects of the pneumatics system, with the exception of the compressors. Over the past year and quarter, we have seen strong economic growth around the world. This growth has also been reflected in SMC's financial figures. SMC's revenue has increased significantly during the past year and quarter, and similarly, gross margins and EBITDA has remained consistently high from year to year. It's good to understand that SMC's business is cyclical, as the growth history shows. Therefore, growth forecast must include a significant safety margin. Like many quality companies, SMC has a stable financial position supported by a huge net cash position currently being 3 times EBITDA. Another company whose share price rose as much as 15.4% during the quarter is Old Dominion Freight Line. Sifter invested in Old Dominion 2020. Old Dominion specializes in less than truckload freight, which means that the company uses large trucks to transport goods between terminals for several different customers at once. One of the secrets of the company's competitive advantage is the density of its network, which explains the reliability and speed of freight traffic. The dense network also makes companies' truck utilization the best in the industry. In other words, they collect orders in small batches from different industry players, which makes margin per transportation much more profitable for Old Dominion. The growth of the company has been on an upward trend year by year. During the current year, the recovery of the US economy and the growth of online commerce have further accelerated the development of Old Dominion sales and margins, and their figures are the best in the industry. So what is the outlook for the company? We believe that the Old Dominion will continue to have the ability to increase its market share by expanding the number of its service centers. Historically, the company has been able to make a better return on investment than competitors on average. And that is what we like, the fact that the company has decided to continue to expand and intensify its network. We believe that this density return formula will improve the company's EBITDA in the long run. And in addition, the company will gain a greater share of the growing market. Next, let's look at a few of the Sifter's portfolio detractors during the third quarter. Let's start with the Swedish-American company Autoliv. Autoliv is a manufacturer of passive safety devices in cars, such as airbags and seat belts. Over the past year and quarter, Autoliv has suffered from a shortage of semiconductors and components. Car manufacturers have not been able to produce cars as much as they wanted, and this is indirectly reflected in Autoliv's sales and profitability. In addition, the company's business has been hampered by rising raw material prices, which slightly worsens profits. We think that in the short term, this has contributed to the decline in Autoliv stock price. However, as long-term investors, we believe in Autoliv's business. We see 5 positive things in Autoliv business performance. First, Autoliv has received orders faster in recent years than demand for cars has grown. In other words, Autoliv has won market share. The second, company returned a quarterly dividend of 0.62 euros per share, which is a good thing. Third, Autoliv's management has skillfully navigated the business in a very difficult environment, and thanks to a cost-cutting program, the operating result was better than expected. Fourth, the potential demand boost for car production is indicated by the fact that the pent-up demand for new vehicles is strong, and correspondingly, inventory levels for new vehicles are at record lows. For example, in North America, the inventory levels is about 1.4 million units, which is about 35% lower than what its manufacturers usually carry. And finally, as a long-term trend, we are seeing an increase in the number of safety devices in cars, especially in developing countries. All in all, we believe in Autoliv's strong market leadership and the management ability to lead the company. In addition, we believe that car manufacturing capacity will return to normal and Autoliv will be in a good shape in this market. As the last company, I will say a few words about the French aircraft engine manufacturer Safran, whose share also suffered a decline of about 6% during the quarter. Safran has been in Sifter's portfolio since 2015, and we initially invested in it because the predictability of the company's results have been very certain. Safran's business and profits have been based on an order backlog of about 9 years and the ongoing maintenance services. We still believe that Safran's competitive position is strong, based on the best LEAP engine type in the industry. And the barriers to entry are also really high. So why has Safran's stock crumbled during this year and especially this quarter? Well, the answer is pretty obvious. In the post-corona lockdown environment, flying and aircraft manufacturing decreased drastically. Uncertainty about the future of flying continues to affect all players in this value chain. However, we think that the situation in Safran is a bit brighter than, for example, aircraft manufacturers like Boeing and Airbus. Safran's earnings model and ability to make money are largely based on engine maintenance and service contracts. We anticipate that Safran's business will gradually recover and the bottom has already been reached. But how fast will the recovery be to pre-pandemic levels? One of the best metrics to assess flight recovery is the ASK meter, which stands for available seat kilometers. In other words, how many kilometers the planes have flown. The yellow line in ASK narrowbody in the picture describes the planes that use Safran's engines. We can see that the flying has recovered strongly, but is still a long way from the pre-pandemic levels. However, the direction is upwards. There has been a lot of discussion in media whether the stock market is a bull or are we expecting to see a crash or bear market in the near future. To be honest, we don't know, and we don't put any effort into trying to speculate on that. At the core of Sifter investing is to follow the business metrics. And when we compare Sifter businesses' key indicators against S&P 500 companies, we can say that the return on invested capital, for example, has been very high for Sifter businesses for years and over double compared to S&P businesses at the moment. Also, operating margin, which is one indicator of profitability, is consistently high and clearly about S&P 500 companies. When it comes to sales growth, we can see the post-corona year pent-up demand in the figures, which is the biggest sales growth jump in Sifter's history. Net debt to EBITDA tells something about financial condition of Sifter businesses, and median Sifter company is debt-free, and the same cannot be said about S&P 500 businesses, which are higher leverage on average. EV/EBITDA valuation implies that Sifter businesses are currently a bit more expensive than S&P 500 companies on average. But quality is never cheap. Based on these figures, we can feel quite secure that Sifter investors own high-quality businesses. At the end, I would like to remind you that the companies or ideas presented are only for Sifter Fund activities and are not intended as investment advice. Thank you very much.